Here we go. We are live with Cowboy Metals here on Gold Silver Pros YouTube. Welcome everybody to the show. I'm going to wait for YouTube to give notifications and let everybody know we're in, and we will get started shortly. We are live here. Thank you everybody for joining. I see quite a few people in the chat. Michael Sayre is here. The Cool Breeze, Hayden Martin, Jim Vestergaard, Jeff Keller, Silverback Cave. Everybody welcome in. We're going to talk today about the BIS versus the LBMA on gold and who's going to win. We'll get to that here in just a moment. I want to give it another couple minutes for people to get loaded in. We've got your update on the NSFR and Basel III. Once again, welcome into Tobacco Stacker. Peter Langvin is here. Hayden Martin, Jim Vestergaard, Prepper Days is in. Once in Exile, Philip Smith, everybody, welcome. We'll get started here in just a moment with the content as everybody gets into the chat and we get everybody loaded up. Welcome, Adam Kozowski, Tim Champagne, Gary Porter, Mutant Ryef, Mari Sharon, hopefully I'm saying your name correctly. Hello back to you, Squirt9, from the great state of Texas. This is Cowboy Metals Live. We broadcast from the great state of Texas. And we love Texas, and on our live streams, we don't like to take a lot of BS. So this is a no BS live stream, and we're going to be bringing you some information on what's going on with the London OTC market in gold, the LBMA. But first, I actually wanted to start with something else. We're going to lead off with something from Wall Street Silver. I'll go ahead and share a screen. And there was an interesting article that came out about Venezuela. So we'll get started here. Venezuela apparently wants its gold back now, as it's being reported on Wall Street Silver. And Venezuela is needing that gold because oil revenues are down. They need the gold to sell to get things that they need for their country, because they import a lot of their stuff other than the oil and gas. They import most items in their country. So they need food, they need medicines and such. And so they're trying to get their gold back. A nice little article here on Wall Street Silver talking about that. There's even a video posted here if you want to go look at it. It's called Venezuela Wants Its Gold Back Now. And I'm going to show you from the BBC News what's going on with Venezuela. They have filed a claim with the Bank of England over getting their gold. The gold is being retained following British and US sanctions on Venezuela. Venezuela says it wants the Bank of England to sell part of the Venezuelan gold reserves and use the fund to fight the spread of coronavirus. And it says it's agreed for the money to be sent directly to the UN to ensure it's not used for other purposes. So Venezuela at this point doesn't look like they're just trying to repatriate their gold. They're just trying to sell their gold so they have money, and they're willing to use the UN as an intermediary. Doesn't sound as though Venezuela is trying to get their gold back and Maduro's trying to run away with it. I think what they're trying to do is actually legitimately use it for their economy. Now, whether they're going to use it for, the military or whatever, it remains to be seen. But why is Venezuela's gold in the UK? The Bank of England is the second largest keeper of gold in the world. It has approximately 400,000 gold bars. Only the New York Federal Reserve has more. And it's one of the largest gold vaults in the world, over a 320-year history. And why does Venezuela want its gold? As I explained, despite the country's oil riches, Venezuela economy has been in free fall for years due to a combination of government mismanagement and corruption. So a lot of corruption going on with those communist regimes down there, but they're desperate to get their gold. The Bank of England has held on to it. And the Bank of England's stance so far is it refused the request. It said publicly it did not comment on customer relationships. But the decision, however, came just days after Mr. Maduro's rival, Juan Guaido, had declared himself president, arguing the 2018 election was returned Mr. Maduro to power. So the Bank of England apparently is refusing to give Venezuela its gold over a political issue. I'm not sure if that's really relevant. If it's Venezuela's gold, it's Venezuela's gold. I don't know why the Bank of England has any say in that whatsoever. I am supposing that means that the Bank of England may not have the gold or may have leased it out for some other purpose. I don't know this, but why else would they care if its legal title goes to Venezuela? And if they're having any sort of political issues, that's not for the Bank of England to intercede in that. So while the Bank of England never went beyond saying that it did not comment on customer relations, it thought the international sanctions on Venezuela and regulations on preventing money laundering influenced this decision. Sounds like a pretty weak excuse to me, but nonetheless, there you have it. If you want more on that, go to Wall Street Silver. Venezuela wants its gold back now, and you can see information on that. Another big story that we have that I'll share in just a moment. I'm going to go back to the chat and see how you guys are doing and who has entered. It looks like a Nazi YouTube is here. Mark M, welcome to the program. Philip Smith, hi from Saskatchewan, Uranium Capital. And Tim is here. Rick is here. Silverback Cafe is here. Welcome everybody to the program. If you want to ask a question on my live streams, all you have to do is hit that super chat and put your question in there and I'll get it answered. I'll try to scroll through the chat and answer other questions, but there's no guarantees. Once we get this up and running, there's usually quite a bit of people in here. Hi, Rick, how you doing? Good to see you. JR 1888, Marco Garcia, Wide Winger, everybody, thank you to the program. Okay, we're gonna go back to our stories. I got one more story before we get into the key presentation, which is the LBMA's battle with the BIS over NSFR and gold. And I've got a little bit of a different take than everybody else. I'll leave that as a teaser. But before we get back into that, I'm going to go back to the share. So one of the other things I want to talk about, other than Venezuela trying to sell its gold basically and use the UN as an intermediary, is what happened with London Vault Holdings data. You guys might have remembered about a month ago, I did a video on the movement out of COMEX over 40 million ounces. Actually, it wasn't a month ago, it was about 2 weeks ago. 40 million ounces of silver out of COMEX. And then I was looking at different data flows across the world to see where that silver may have gone. So I came here to the London Vault Holdings data and looked at silver for the month of March. And it had a number here, I believe is 1.249 billion ounces of silver, which would have been an increase of 100 million in a month. And I looked at that and said, could they add 100 million ounces in a month? It was kind of sketchy. And this is what it looks like. Ronan Manley has it here on his website. The original number reported on the LBMA was 1.249 billion ounces of gold. This is thousands, so this would be 1.249 billion in March, which would have been an increase of about 125 million in a single month, which is a ton of silver coming into the LBMA's vaults. Well, now they have corrected it. They said we made a calculation error, and as of the end of April 2021, it's 1.15 billion. And the correct figure for March should have been 1.143. So they've now corrected that on their data, 1.143 here. So the London market doesn't have nearly as much silver as they had reported in March. Of course, it's something like 3,300 tons of misreported. They're saying it's basically a fat finger or a counting error. That's a really big counting error. One wonders if there's something more behind that. We don't really know. But this just goes to show that whatever is being reported on exchange, there are sketchy controls around who actually has what and how well those results are audited and presented. I've said before in both the London markets and the COMEX markets, I think the regulatory authority and the supervising authority over the reporting of the physical metal is pretty sketchy. So I really don't trust the numbers anyway. But this just goes to show that whatever is reported, you can't really count on. You can't take it, you have to take it with a grain of salt, essentially, that the reported numbers probably aren't going to be correct. All right, going back to the chat here, guys. Stoke Brokers is in, a voice Deether is in. I think we've got it all loaded up. We've got over 200 people in the chat. Just a reminder, if you want to ask me a question, have me answer it on air here, put it into a super chat and I will pay attention to that and get back to you. All right, now we're going to get to our feature presentation, which is the LBMA versus the BIS and gold. Who will win? As I teased just a minute ago, I have a different take on this than a lot of commentators. And that's why I chose to publish this a little bit late. That's why I chose not to immediately go into publishing the story, because I wanted to do a little bit of research and thinking about it. And I'm not sure that I necessarily agree with everybody else on what's going to happen. But we're going to have some resources for you. I've got a PowerPoint where we're going to walk through it. But there's some resources we've looked at before and a new one we haven't. This is the new report we're looking at. It's from the World Gold Council and the LBMA, and it's called The Impact of the NSFR in the Precious Metals Market. This has been making its way around Twitter quite a bit and on YouTube. And again, I wanted to take some time on this. It's like 58 pages. I really dove into it, did some additional research. And again, I've got a different take on this than most people. We'll also be referencing this paper that I addressed a month or two ago with the Basel Committee on Banking Supervision, the Net Stable Funding Ratio paper, which was published in October 2014. I've referenced this before. This will be another one of the references I use in today's presentation. And then I wanted to talk a little bit about the BIS. Who is the BIS? Well, here is the organization governance chart. It has a group of governors and heads of supervision, the GHOS. The chairman is Francois Villeroy d'Agalhou, the governor of the Bank of France. And then you have the committee. The committee, the BCBS chairman is Pablo Hernandez de Cos, governor of the Bank of Spain. And then you've got all these working groups under it. And then you have the secretary, which is Carolyn Rogers. So that's who the Basel Committee is as a part of the BIS. Just wanted to throw that out there in case you guys were not aware. So again, these are the 3 resources that I'll be using today in the presentation, and we'll go ahead and get started with loading that presentation and we'll get into it. Once again, welcome Dude Boy, welcome Eric Chiasan. We're at 240 subs. Remember, super chat if you want to ask a question. Let's go right into the presentation. The name of the presentation is Basel III NSFR versus the LBMA, and the LBMA's quite detailed response on gold's role in the system and why I think I may actually agree with the LBMA on this one. Let's go ahead and get the presentation started. So we're going to go to the first slide, which is who is the LBMA? So right here in the paper that the LBMA published, they are the independent authority for precious metals representing the global over-the-counter market. Their mission is to ensure the highest levels of leadership, integrity, and transparency for global precious metals, so on and so forth. Getting down to the second paragraph, it says here, the London Precious Metals Clearing Limited, LPMCL, was created by the LBMA members in 2001 for the specific purpose of developing and administering a system for the clearing and settlement of gold and silver transactions. So LPMCL is the clearinghouse for the LBMA. Okay, it's a not-for-profit company owned and operated by 4 banks, only 4: HSBC, ICBC Standard, JP Morgan, and UPS. The default settlement location for most global OTC spot gold and silver is Loco London using the LPMCL account. And this type of account is referred to as an unallocated account. The member's balance sheet treatment for unallocated account means that the metal amount in ounces is treated as an asset and the client's credit is treated as the corresponding liability. So that's the basics of LBMA, LPMCL, and the 4 member banks, which are again, HSBC, ICBC, Standard Bank, JP Morgan, and UPS. All right, moving on. You know, one of my mentors in my career when I was working for the Big Four said, Rob, if you listen to people, they'll tell you both who they are and what they want, and all you have to do is listen. And this is a great lesson for me because it taught me to listen more and talk less and listen to what people were saying. And what the LBMA is saying here is that gold is the ultimate currency, which I think is an astounding revelation because so many people in finance for years and years and years, especially since 1971, has said that gold has lost its monetary attributes. Gold is just an asset class. You know, you can't earn interest off of it, which this paper disputes, by the way. It offers data quite convincingly that you can earn interest on gold through leasing. But in any cases, I think the LBMA is trying to dispel here the fact that gold is not currency. So it says here right in the paper, the PRA should note that when gold is deposited and lent, it's treated as the currency by market participants. And when functioning as a currency, gold has no cash funding requirement when used as the underlying asset in financing transactions. An appropriate regulatory treatment would mean that gold loans backed by equivalent deposits from central banks would not be negatively impacted by the NSFR. In other words, they're saying gold is a currency here, not a low quality asset or a high risk asset, as the NSFR is kind of trying to treat it as, or at least discounting it, discounting gold as a currency. HQLA stands for high quality liquid assets, and the LBMA is making the case here that gold should be considered the ultimate high quality liquid asset, even though Basel III does not specifically and explicitly say that. It says the LBMA is saying that the PRA should also review gold's position as a high quality liquid asset. The LBMA, the World Gold Council, and the members of the market, each believe that gold should be reclassified as an extremely high quality liquid asset. In other words, the highest quality liquid asset. I happen to agree with the LBMA here. I agree 100%. The position is justified by the trade data that members have been reporting to LBMA since 2018. This quantitative data confirms that gold retains consistent liquidity characteristics of extremely HQLA and proven to be highly resilient to global liquidity shocks, such that as early as 2020. So there are 2 study papers that are attached to this paper that I'm talking about. So the LBMA has their reasoning why gold should be treated as a currency and as a high quality liquid asset, but they also have 2 papers behind it, which showed during times of turbulence, once during coronavirus and I think during the last recession, in which gold had tighter spreads, was more liquid, and was more sought after than things like stocks and other things like that during global crises. So I think the LBMA, they had submitted this research previously to the Basel Committee, but this time they actually published it in a paper and put the research behind it. So I actually got to read through it, and I agree 100% with that research. It's really good research, and it really it really shows us why gold should be considered the asset of last resort and the highest quality currency. So again, I agree with the LBMA so far in this paper. LBMA admits that gold is the asset of last resort. Now, this is astounding because the LBMA is supported by commercial banks, right? And the LBMA facilitates transactions between commercial banks, producers, merchants, central banks, so on and so forth. And it's rare for people to admit that gold is the asset of last resort, but look at what they say here. Precious metals markets are used daily by a wide range of market participants, from central banks to jewelers to mining companies and manufacturers. Gold is the largest and most important precious metals market. Gold is used in a wide range of consumer goods, industrial processes. It is also commonly used as a safe alternative to foreign exchange currencies, in other words, cashes of the world, and is the ultimate safe harbor asset, offering zero credit risk and high liquidity characteristics for both professional and retail investors in times of uncertainty, as was evidenced during the early COVID period of April-May 2020. The data available from this period suggests gold characteristics as an extremely high quality liquid asset. Now, again, that research is in this paper. I'll have the link to that paper at the end of this presentation. If you want it, you can go look at it, and the research is very clear. And I think it's great that the LBMA is admitting that gold is the asset of last resort. It's basically, you know, the liquidity is great. It's better than basically any other financial asset during times of crisis. I agree 100%. So far, I have no qualms with what the LBMA is saying. Now I'm going to stop a share real quick. I'm going to come back to the chat and see if you guys have asked any questions. I do not see any questions in the chat. Checking the sound to see everything is fine. Raise your hand if you can't hear me, but if not, we're going to keep going. All right, we will keep going, guys, with the report that we have, the presentation that we have. So essentially, the LBMA admits that gold is asset of last resort. And we're talking about which gold is being focused on. So the NSFR, the net stable funding ratio, is really discounting unallocated gold. And unallocated gold is gold that's not held on the balance sheet, at a bank or depository institution as its specifically owned asset. We're talking about unallocated gold. That's what makes up the London OTC market. Now, most of the trades that occur in London OTC by mission of the LBMA are not directly gold for cash. They're really a derivative transaction, so you can get exposure to the gold price, and it's sort of there's a paper derivative on top, but you can get access to that gold, and the OTC market does facilitate that gold. However, since it's unallocated, meaning it doesn't belong to any specific entity, it's just on the member bank balance sheet for use in transactions, as the gold is flowing from like a producer to an eventual merchant or from one banking entity to another. It's unallocated, meaning it's not owned by the banks that are holding it. They're holding it for purposes of facilitating that trade. And we're talking about the unallocated metal. So looking at the second section here, the majority of precious metals held by LPMCL, those are the clearing banks, for clearing and settlement purposes is unallocated metal. And because they're clearing banks, they're holding that metal to facilitate the trade. They're not holding it on their books as an asset. So it's held off book, okay? And it's considered basically in process. And this is the main argument the LBMA makes. That gold is in process from one entity to another. So we're not counting it as an on-asset balance sheet item. Therefore, it shouldn't be subject to NSFR requirements from Basel III. That's the main argument they're making. It says here, this is metal deposited with clearing banks by market participants. It is an account where specific bars are not set aside and the customer has a general entitlement to the metal. This is the most convenient and cheapest and most commonly used method of holding metal, which I don't disagree there, by the way. The holder is an unsecured creditor. The metal, therefore, can be used by the clearing banks to clear and settle physical precious metals transactions between market participants. And the unallocated metal is fungible and as such provides the liquidity of the clearing and settlement system. Further, it allows the clearing banks to debit or credit market participants' accounts with metal immediately before the seller's metal is delivered to the buyer, which usually occurs within 2 working days. Unallocated metal deposited with the clearing bank is recorded as an asset and is held on balance sheet. It is subject to the proposed RSF calculation. And they're saying that it shouldn't be. This is the argument. Precious metals are recorded on the balance sheet of LPMCL members and are accounted for as assets subject to the 85% required stable funding factor. So without getting into all of the different acronyms in terms of Basel III, essentially what this means is when you have unallocated metal, it's being reported on balance sheet, and that required stable funding ratio requires these banks then to back up that gold with 85% high quality liquid assets such as cash or other high quality liquid asset derivative products. And the clearing banks are saying, why would we do that? This gold is in transit from one to another. It's a trading market. Why do we have to back that unallocated gold up with other assets of high quality liquidity? Because at the end of the day, we're not keeping the gold. We're not using it to capitalize the banks. It's trading. This is the argument LBMA is making. And I don't necessarily disagree with that. But they're saying there's no offsetting effect. As a consequence, credit institutions would be obliged to hold stable funding at a value of 85% of precious metal assets. In such circumstances, clearing and settlement will become a significantly more expensive business for MCL members, and we would expect that one or more members would exit the market and cease clearing and settling transactions. And remember, there's only 4 members, 4 banks we talked about earlier in the video. So if any of them leaves, that's a big deal. 25% each time one of them leaves. And if all 4 of them leave, there is no market. They say here currently there are 4 members. It would be extremely difficult to attract new participants. They say, I don't know how true that is, but this is what the LBMA is saying. So putting this in plain English, what are they saying? The Basel III regulations treat cash as king, but they treat unallocated gold held on balance sheet as a risky asset. Therefore, the required stable funding, or the RSF, must equal 85% of unallocated balances, meaning unallocated gold is treated as an asset with high risk and need of more backing. And what the participating banks in the LPMCL, of the LBMA are saying is that essentially we're not holding this to fund our banks. We're holding this for the trade and for this trading market. That's their argument. The LPMCL banks would realize much higher costs from capitalizing unallocated gold positions with the new requirement of the required stable funding ratio as a part of Basel III, which would take effect supposedly this coming June. And with only 4 participants, it would likely collapse the London OTC market. So a lot of commentators have come out and said that Basel III will collapse the LBMA. I don't disagree with that part. If it's a requirement that unallocated positions in the London OTC market, it would be backed with 85% cash or similar type of asset, it would significantly raise costs and would disincentivize banks to participate, and one or more would drop out. And eventually that would, I think, collapse that market. And the question is, why would anyone want to do that? And we'll get to that further in the presentation. What is at issue here? What is the issue? The LBMA has repeatedly said that physical gold is a high quality liquid asset and should be treated as such. I 100% agree. And even if it's unallocated, as long as the creditors have claims to that gold and that gold is going to settle physical transactions, I don't disagree that physical gold is a high quality liquid asset. Any derivative on gold should not be considered high quality liquid asset, because that's where you get into where you have multiple claims on a single ounce or a single bar. But where it's physically traded, I agree, it's a high quality liquid asset. The LBMA therefore is asking for acceptance of unallocated gold as a high quality liquid asset. And they submitted data to show the stability of gold in market turbulence. Again, that's in the paper, which there will be a link in this presentation for you if you want to go read those 2 research studies. The regulators have not budged. The BIS regulators not budged, so the data did not convince them. And the question is this an issue with the unallocated gold or the LBMA system? Is the BIS trying to break up the LBMA system, or do they really have an issue with the unallocated gold? Meaning, when the BIS looks at the trading data that the LBMA has submitted already, recently submitted, did they look at it and say there's not evidence that actually all of that unallocated gold actually exists, or is there some other issue with that system, some other liability that we don't know? Or is the BIS issue with the LBMA system itself? And that might be the bigger key here. The LBMA also in this paper goes on to state that alternatives to the OTC system are untenable due to other restrictions of Basel III, which appears to be correct. So this is something I did not recognize in my previous 4 Basel III videos that I did, because this wasn't a point brought up. And when you go through all of the requirements of NSFR and the Basel III, there's a lot there. But the LBMA is basically stating if you got rid of the OTC system and you went to another system, then there would be higher costs due to the same Basel III requirements on that system. So it would raise the cost. And they appear to be correct. So some cursory research I did on this led me to believe the same thing. It led me to support the LBMA's claim that if you got rid of the OTC market, it would make getting gold through that market more expensive. Now, does that mean that we shouldn't get rid of the OTC, that's not some sort of oligopoly that we should deal with? Potentially we should get rid of the LBMA and maybe some of the collusive and other questionable practices that go on in that market. That being said, the question is what comes next? So consequences of NSFR to the LBMA. So this is what the LBMA says the 4 main consequences could be in their paper if they have to abide by the NSFR and back up their unallocated gold with 85%, high quality liquid assets. They say that the required stable funding for short-term assets would significantly increase costs for the clearing banks to the point that some would be forced to exit, and it may even collapse it. And I don't disagree with that. It would drain liquidity. The required stable funding would dramatically increase costs for remaining members taking gold on deposit to be held as unallocated metal relative to the cost of providing custody of allocated metal. This would prevent LPMCL clearing banks from holding unallocated metal and drain essential liquidity from clearing and settlement system. I don't disagree with that either. I mean, the whole point of the OTC system is to do it as cheaply as possible, and to make sure gold is flowing through that system. Now, the question is about the derivative exposure in that system, and is that is that not being accounted for here by the LBMA? Third one, dramatically increased financing costs. The required stable funding would penalize LBMA members who hold unallocated balances of precious metals. This would increase the cost of short-term precious metals financing transactions as stable funding costs are passed through to non-bank participants. And such cost increases would impact miners, restrict refining, and raise the cost of inelastic key input to industrial and consumer goods. This includes some essential medical equipment. So some people have panned this claim by the LBMA, and I'm not sure I completely disagree. If you got rid of the OTC market, would it be harder to find cheap ways to move your metal? Probably. New markets would have to emerge. There would be a time factor there. There would probably be some increased costs. How much would it hurt them? Honestly, I really don't know. It's been so long since we've really had an alternative system. I don't know if anybody really knows. We could guesstimate on it. But I think to some extent the LBMA is correct, but we don't know if we could put together a more efficient system. I tend to think we could. I think it would be less centralized and therefore less under control of those 4 participating banks and the LPMCL. But at the end of the day, we really don't know. Curtail central bank operations. Fewer LPMCL clearing banks may curtail central bank deposit lending and swap in precious metals. Those operations are essential to offset the cost of storing gold reserves and generating income. In addition, it provides important liquidity. So I'm going to read between the lines here on these 4 things. And basically what it's saying is this: it would disrupt the LBMA monopoly and open it up for further competition. 2, it would drain liquidity from that part of the system, not necessarily from world liquidity. It would increase financing costs, which is probably true. But the biggest point here, curtail central bank operations. If you got rid of this system, the OTC market and the LBMA, the central banks would find it harder to do their transactions, their swaps. I think that's a key there. So the BIS is proposing a system which would break up the current central bank swap and lease system. Now, is that good or bad? Because at the end of the day, you're still going to do leases and swaps, but it's that it wouldn't go through that market. In other words, the control of the central bank lease and swap market would move somewhere else. Where does the BIS want that to move if they don't want it on the LBMA? And further, the LBMA has long been supported by the Bank of England. The Bank of England has had ties to the London bullion market for forever, dating hundreds of years, and they've had ties to the LBMA since it started. So is this more about a power struggle between the BIS and the Bank of England and wresting control of that gold market from the current system and giving control to someone else? I think that may be the bigger point here. The LBMA has proposed a solution. They're saying interdependent assets and liabilities. They note that Switzerland proposes to treat precious metals assets held by banks resulting from loans as interdependent assets and liabilities, therefore relying on the equivalent Article 428F. I've looked up that article. I ran through all the components of that article. The link to that article is here in the bottom of this slide at lexparency.org. I went through it and I didn't disagree with what Switzerland proposes here to treat precious metals. It would exclude the majority of precious metals held by Swiss institutes from the NSFR calculation. And I don't disagree, because when you look at 428F CRR2, it treats it as like a pass-through, which the OTC is. It's a trading hub. It's not held for long-term to be an asset on the balance sheet of the bank for purposes of capitalizing the bank. It's meant to be a trading market. And when you look at 420F2 CR2, I don't necessarily disagree with Switzerland's proposal. LBMA says that 428F CR2 may offer a viable means to at least safeguard clearing and settlement for precious metals transactions, meaning clearing and settlement means trading of. We believe that the system should be considered a market utility, without which precious metals transactions would take many days to settle, resulting in increased settlement risk. Within the 4 clearing bank members of LPMCL that provide the service, there will always be a corresponding asset and liability for every transaction. So they're saying it's a transaction asset liability. We're balancing the books. Note that this is not a novation agreement where a central counterpart takes on all credit risk, but simply a mechanism where the client instructs the clearing bank to make or take delivery. So in other words, the OTC market is not where you have a central clearing hub that takes all the risk, kind of like the COMEX, which guarantees all the trades. It's more of, it's an asset and liability. There's a trade, and the LBMA and the LPMCL is just facilitating that trade. Therefore, it should fall under this other article of the Basel requirements. So they note, therefore, propose that the PRA exclude the clearing and settlement of precious metals transactions. Now, again, I can't disagree with this. I'm not disagreeing with the LBMA here. I'm not disagreeing with how they're categorizing gold in this solution. And I'm sure somebody will tell me I'm nuts, but I don't see the issue with what the LBMA is proposing here. I think this more has to do with the power struggle. I think here are the key questions about what Basel III really means. Now, I've said before that Basel III would help gold retain status and enhance its status as a high quality asset as long as it's hedged in a derivatives market. But I think that's because Basel III is focusing on cash as king. Honestly, I don't think cash is king. I think gold is king. And I do think that gold should be treated as a high quality liquid asset. I agree with the LBMA there. And I think that's one area which the Basel III has undervalued gold. But what did the European Banking Authority and the Fed see with regards to the London OTC market that they still question? So the OTC, the LBMA went to the European Banking Authority and the Fed and say, hey, here's data showing the trades. Why are you still wanting to cause us to back up our unallocated gold positions with 85% of some other high quality liquid asset? So what did the European Banking Authority and the Fed see there that they didn't agree with? That's a question I haven't seen answered. The EBNA and the Fed basically said, we don't agree with the LBMA, but why? I haven't seen the position papers that really outline the specifics of why. So what did they see about that London market that they don't like when they looked at the data? That's a key question here. And, I can't fully comment on whether the LBMA is right or wrong here until I know the true objections of the European Banking Authority and the Fed. Are the regulators, in this case, the BIS. They're not really regulators. They're sort of standard setters. And if you look at the BIS website for these regulations, they don't have teeth in them. They're more recommendations, but the banks tend to take their cue from it. So are those regulators trying to break the market mechanisms for the gold trade? Why would they do that? Who does that benefit? Obviously, if you're breaking up the LBMA, you're hurting the Bank of England's relationship in the London gold market's place in international gold. So that would go somewhere. They're going to form another market. It's going to form somewhere else. Does it go to China? Does it go to Europe? How does it benefit the BIS? These are key questions I think that need to be answered. To me, this is not just about gold's role in the system. I think it's very clear that gold has a stronger role in the system. And I think that's clear by the Basel III requirements. But I almost think as though the Basel III requirements were written to disrupt the current power centers in international gold trade. To me, that's more about what this is about. So the key question is, what replaces the LBMA for facilitating international gold trade and gold lending in the supply chain? In other words, who gets the power around gold? If it's the ultimate real asset, which the LBMA admits to in their paper, who gets control of that market? And is this part of the Great Reset? As I talk about the Great Reset, I'm going to give you some of the resources in the paper. So here's the top one's the letter I was talking about, that the LBMA is basically saying, hey, we want to recategorize gold here according to Switzerland's argument, at least, and not have to back up our unallocated gold with 85% cash or whatever. And also put the Basel III NSFR rules in there. I've looked at that paper a bunch of times, but I put it here for reference for you guys. But the key question here, guys, is, why? What is going on here? Is this part of the Great Reset? The Great Reset, we know, a large component of that is central bank digital currencies. It's about taking gold more to the core of the central banking system and getting it out of the hands of the retail market. It's more about putting some sort of derivative, an electronic derivative, in the hands of the people as money. So is this move to disenfranchise the Bank of England and London from the international gold trade part of that Great Reset? And who benefits from that? What is that for? I honestly don't know that question, but that's to me more about what this is about than it is about how gold is treated in the system. It's more about taking power away from the current centers and that power going somewhere else. And I have a feeling it relates to the Great Reset, but I'm not putting it all together quite yet. I haven't made my final conclusions here. I've got a feeling something's going on, but I need more information. The auditor in me is saying, there's a little bit more information that we need here, guys, to figure out what's going on. I do believe now more than ever that the LBMA is fighting for its life. I think if they choose not to be a part of those Basel III recommendations for funding the banking system, they're going to be ostracized. They're going to be put aside. I think eventually, if they were to try to adhere to the NSFR, it would collapse the OTC market. And I think they know that would be the end of them, and that's why they're fighting back. I don't disagree with them on many of their points. And the key question is, who's taking over? Who's trying to take over in this power play through the Basel III NSFR requirement and related to gold? Who's taking over the gold market? Is China involved in this? Is it the European Banking Authority? Who are the players here? You got to look at the players and see who benefits from this. Whenever you have something like this come out, which is foundational to the financial system, it's always who's trying to take power from whom, who's trying to control what. And that's the key question. So I'm going to be following this, guys. I'm going to be following all the way to June. I promised that I am going to do a video in June about Basel III and about NSFR, so I will still do that. But I really wanted to bring this to you guys because something fishy is going on under the surface. And I want you guys, if you find research, I want you to email me, contact me. If you have an opinion on this, feel free to reach out to me. I'd like to hear it. There's more pieces as of yet to put together to this little puzzle. I'm not convinced we're done here on Basel III, and I'm not convinced we're done here on the changes that are coming to the banking system and how all Basel III relates to the Great Reset. It is part of the Great Reset. And there are more questions to be answered here. So we're gonna continue to follow this, guys. We're gonna continue to comment on it. We'll be back probably before June to talk about this, but for sure in June, before June 28th, to talk about how Basel III could change. At the end of the day, I do think in a lot of ways it's going to help us find truer price discovery in gold, unless the system that we get is worse than the one that we have. And that's my concern here. And that's why I want to watch this. So guys, if you have questions, feel free to put them into super chats. I don't see any. Thank you everybody for joining the program. Very grateful is here. Jacob Siegel is here. JJ Stacken is here. Danny Fott is here. We have about 500 viewers right now. Thank you everybody for joining the channel. We appreciate that. We love interacting with you on Sundays to do our live stream here in Cowboy Metals. And we call it Cowboy Metals because we're in the great state of Texas and we don't take a lot of BS. And this is the no BS live stream zone. Just a reminder, if you guys are interested in the subscription newsletter, you can go to goldsilverpros.com and subscribe there. You also get access to the wonderful Gold Silver Pros University and also special publications, which we email out from time to time. Guys, I think this is going to about wrap it up. Thank you everybody for joining. Remember to go visit Wall Street Silver, look at that article on Venezuela gold and how Bank of England is not allowing Venezuela to even sell their gold and run the funds through the UN so that they can get what they need. So I think Bank of England may not have all the gold they say they have, which is why they're not giving it to Venezuela. And maybe that relates to what we're talking about here in terms of the BIS trying to shake up the world gold market. Maybe there is an altruistic goal here, maybe not. Maybe it's a power struggle. We don't know. More to come on that. Thank you so much, guys. We're going to call it a day. Oh, I have a big bombshell for you. On Wednesday, I'm going to be talking about a major global mint. And we're going to be documenting data about how this mint may be in serious trouble. This is going to be a big bombshell in the gold market. You do not want to miss this. Coming up Wednesday. We'll premiere it at 7 p.m. Central Time. Stop back by the channel. The big bombshell in the global gold market is coming, and we've got all the data that you're going to want to see. And I guarantee you nobody else has what we have here. So stay tuned to Gold Silver Pros. We're going to bring you that data and that knowledge that you can't get anywhere else. Till next time. Thank you so much, everyone. We'll see you next time.